These are your Chapter 8 practice problems. Question number 1 says that during the most recent year, the company had the following data associated with the product that it makes. We have no beginning inventory. We produced 11,000 units. We sold 7,000 for $500 a piece. It gives us our variable cost, also gives us our fixed cost. We are looking to calculate ending inventory, cost of goods sold, and the operating income using absorption costing, and then in part B we will use variable costing. To start off with absorption costing, the first thing that you want to do is calculate your cost per unit. Remember to calculate your cost per unit under absorption costing. You're going to include all of your product cost. So all of your product costs would be your direct materials, plus your direct labor, plus your variable overhead, plus your fixed overhead. So if it's absorption costing, it's direct materials plus direct labor plus variable overhead plus fixed overhead. So under the absorption costing method, that's going to give you a product cost of $350 per unit. So once we have the cost per unit, then we can calculate the ending inventory balance. Remember, to calculate ending inventory, you're simply going to take the cost per unit, which is $350 per unit, and multiply it by how many units you did not sell. So we produced 11,000 units. Out of the 11 we made, we sold 7,000, so that leaves you with an ending balance of 4,000 units. So when we multiply that out, that is going to give you an ending balance of $1,400,000. For cost of goods sold, same thing. We want to take your cost per unit, which is $350, and this time we want to multiply it by the number of units sold, because it's the cost of the good. So the cost of the good is $350. Sold, we sold 7,000 units. So cost of goods sold is $2,450,000. For operating income, the equation that you want to use for operating income is to take revenue minus cost of goods sold. That leaves you with your gross margin. And then from gross margin, you want to subtract your selling, general, and administrative expenses. Remember, another term for that are your period costs or your period expenses. And that is going to leave you with your operating income. So first we have to calculate revenue. For revenue, it tells you that we sold 500 units. We sold 7,000 units for $500 a piece. So when we multiply that out, that is going to give you your sales revenue of $3.5 million. So $3.5 million is your sales revenue. Cost of goods sold, we calculated to be $2,450,000. That leaves you with a gross margin of $1,050,000. And then from there, we just want to subtract the selling, general, administrative expenses, and we have $200,000 of period cost. So that is going to leave you with operating income of $850,000. Now we want to calculate the same things. This time, though, we want to use variable costing to do so. Remember, your big difference between variable and absorption is the treatment of the fixed overhead. Okay, so remember, the difference has to do with your fixed overhead. So under variable costing, to calculate cost per unit, you are only including the variable product cost. So your variable product cost would be direct materials, direct labor, and variable overhead. So your cost per unit is $250 per unit. So for ending inventory, your cost per unit is $250. Again, we still have 4,000 units that we did not sell, so that leaves you with an ending inventory balance of $1 million. Then for cost of goods sold, same thing, it's the cost of the good, so $250 a piece, times the number of units that you sold, which are 7,000. So that's going to give you cost of goods sold of $1,750,000. Then lastly, we can calculate the operating income. We're going to use the same formula that we did before. Revenue minus cost of goods sold equals gross margin minus all those period expenses equals the operating income. Revenue is obviously still $3.5 million, but under variable costing, cost of goods sold is $1,750,000. So that gives you a gross margin of $1,750,000. Then we want to subtract out everything that's going to be treated as a period cost. Obviously, the fixed selling and administrative expenses are a period cost, so we want to subtract the $200,000. And then remember, under variable costing, the fixed overhead cost is treated as a period cost. So the fixed overhead is going to be expensed in the period incurred. So for your fixed overhead, it's $100 per unit made. So to calculate total fixed overhead cost, it's $100 times the number of units that were produced or made, which was 11,000. So your total fixed overhead is 1.1 million. Subtract that out, and that's going to leave you with operating income of 450,000. So you'll notice there is a difference in the operating income under the two different costing methods, and what we see here is that when we sell less units than what we produce, or in other words, we produce more units than we sell, then your operating income is going to be higher under the absorption costing method than it is the variable costing method. Question number 2 says everything else being equal under variable costing. A, net operating income will tend to move up and down in response to changes in levels of production. Inventory costs will be higher than under absorption. Net operating income will tend to vary directly with changes in sales. And D, net operating income will always be higher than absorption. The two answer choices that said it will always be higher or always be lower, we can't say that because it depends on production versus sales. If you produce more units than you sell, then income is going to be higher under absorption. But if you sell more units than you make during that time period, then income is going to be higher under the variable costing method. So we have to eliminate those. So your answer here is actually C. The net operating income will tend to vary with changes in sales. Question number 3. New Deal Company produces a single product. Last year the company had operating income of $92,000 using absorption costing and operating income of $98,600 using variable. If the fixed manufacturing overhead cost was $3 a unit, if production was $18,000, then sales, we're just trying to figure out if sales were more or less than $18,000. If you want to refer back to your PowerPoint slides from this chapter, one of the latter slides showed what would happen with regards to sales being greater than production or vice versa. So here, let's just keep in mind that operating income is less under absorption. So in the example we actually worked out, our income was higher under absorption, and it's because we made more units than we sold. So if variable costing income was to be higher, then that would mean that the units that we sell would have to be greater than produced. So it would have to be greater than the 18,000. Question number 4 says, which of the following is true of a company that uses absorption costing? And your answer is going to be C. Unit product cost can change as a result of changes in the number of units manufactured. That's true. As if we're using absorption costing, we are including the fixed overhead. We discussed this in class that the more units you produce, then you have a larger denominator when you take total cost divided by number of units. So the more units you produce, you can stretch out that cost per unit. If you overproduce under absorption costing, you can actually decrease that cost per unit. You can make it lower, which would then lower cost of goods sold and make the net income higher. Number 5, an income statement prepared using variable costing, fixed selling and administrative expense. And your answer is B, would be used in the computation of net income, but not in the computation of contribution margin. Basically, you just want to refer back to what we did with the fixed selling and admin expenses. It's the same under absorption or variable. If it's a selling and admin expense, it's subtracted after gross margin or contribution margin. Number 6, which of the following are inventoried when using variable costing? When we say the term inventoried, that just means which of these costs are going to be used to calculate the cost per unit. Okay, so when we do cost per unit, we're looking at the costs that go into work in process. That's what it means to be inventoried or capitalized. So remember, if it's variable costing, it's the variable product cost. So direct materials plus direct labor plus variable overhead cost. So your answer here is A. Your direct manufacturing costs, that would be direct materials and direct labor. So direct manufacturing costs are direct materials plus direct labor. Variable marketing costs, a marketing cost is always a period cost, and fixed manufacturing costs, that would be treated as a period cost under the variable costing method. For the next couple of questions, we'll use the following information. We have a company that produces and sells a product for 100 a unit. 10,000 units were produced, 80,000 were sold. This gives you some information. Question number 7, what is the inventoriable cost per unit using variable costing? So it's just asking you for your product cost per unit under variable costing. Remember, under variable costing, we are including the variable product cost. So we are going to include direct materials, direct labor, and variable overhead. Sales commission, that's always a period cost. Fixed manufacturing cost will be treated as a period cost under variable costing, and then all administrative expenses are always going to be treated as a period cost. So your answer is 30 plus 2 plus 3, so B, $35 is the correct answer. On number 8, now we're using absorption costing, and what you will include in addition to the variable cost is the fixed manufacturing cost. So under absorption costing, you are going to include all of the product costs, so direct materials plus direct labor plus variable overhead plus fixed overhead. So your answer on 8 is C, $60. For the next couple of questions,